Housing market crash. Will it happen? Since 2020, cumulatively, housing prices have gone up by 40%. Inflation has risen to over 9% at its peak earlier this year. Both of these are insane numbers. Let me explain to you how crazy these numbers are. 40% growth rate over 2 years means that housing prices will double every 3.8 years. The house that you are currently living in will double in value in less than 4 years, while your income would shrink by over 9% due to a rise in inflation. You're right, these numbers are not sustainable. And let me tell you, the good part is coming next. Keep watching. Before we continue, hello and welcome to Tom's Do-It-Yourself Investing, a channel where we discuss personal finance tips, investing guides, real estate, and the stock market. In this video, we'll be discussing if there's going to be a housing market crash next year. If you haven't subscribed yet, make sure to subscribe, like, and hit the bell icon. How did the numbers get so high in the first place? The story starts with a bat soup. In December 2019, a guy decided to have a bat soup and it set dominoes in motion. Everything got locked down during 2020 and it would have killed the global economy. To salvage the situation, the Fed decided to do two things. One, make the money printer go brrrr. Basically, they printed a lot of money. Two, they made loans cheaper. Mortgages got as low as 3%. Lots of people had money, so everyone was spending money. When everyone wants bread and everyone can afford bread, it starts a bidding war. The price of bread goes up, and this is called inflation. This is how we got high inflation in just 2 years. The price of rice and everything nice went up as high as 9% in the past 2 years alone. The second debacle was the mortgage rates. Borrowing money was almost free if you qualified for the loan. The qualifications needed for the loan were have a good credit score, have a steady income source, and the ability to pay the down payment. So a lot of Americans and giant corporations bought up almost all the houses that were available for sale. But this did not come cheap. Think of it like this. If you're selling your house and you see that the market is hot, the houses are flying off the shelves like hotcakes, the buyers have come up with an unlimited money hack and they're buying everything, you would increase your selling price. The market is hot, every price is a fair price. You would sell your house at a higher price than it's worth. That's exactly what happened. The houses were overvalued by 25% on average. And this explains the massive 40% cumulative rise in housing prices in 2 years. So what now? Are the prices going to keep increasing and push people into poverty as rent costs 60% of their salary? Are the prices going to go down? Is it going to be like the '08 crash again? Well, that's the point of this video. Housing prices are not increasing anymore. Why? Remember how I told you a few minutes ago that the government made borrowing money almost free so everyone took loans and got houses? Well, they did the opposite recently. They increased the interest rates to 7%, which is almost the highest in recent history. It is more than double what it was 2 years ago. But what does this mean? Real estate is not an attractive investment anymore. In simple words, there are better opportunities available right now. It's tough to justify a 7% loan rate on a house. You'll most likely lose money if you buy a house right now. So investors are not buying houses right now. This was the intention of the Fed. The demand is dried up, not many people want houses, so the sellers have to drop their asking price. The massive rise in housing prices in 2 years finally came to an end. As long as the interest rate remains at 7%, the housing market will remain tame. So is this it? Happy ending? Of course not. Interest rates are a lagging indicator. This means that the effect of interest rates is felt after some time. This time can be a few months to a couple years. The impact of lowering interest rates and printing too much money 2 years prior is being felt now. So now, when the Fed is overcompensated for its decision by raising the interest rates to a historic high, the impact will be felt 2 years down the line. Maybe over the next few years, the Fed will gradually make the mortgage rates cheaper, which will make real estate a sound investment again. Then the prices will start bouncing back. But right now, it looks like the prices will either continue falling or flatline. Price versus value. Price and value are two different things that ordinary people often confuse. But you're better. Price is what we see, what the item is selling for in the market. It is the same for everyone. Value is more subjective. It's what you believe the item to be worth. It can be different to everyone. When you think the value of an item is greater than its price, it is a good buy for you. If you think the price is too hard to justify its value, you choose to let it go. This is basic economics. This applies to most items, including real estate. Let's learn this with a novice example. You need to reach your friend's house. She lives 40 miles away. The Uber shows it will cost you $60 to get there. You pass. Ain't no way you're spending that kind of money. The next day, you need to reach the airport, which is also 40 miles away. Uber shows it will cost $80 to get there. Surge pricing. You pay it regardless, albeit under protest. Why? Because you value it more now. Your circumstances changed. Historically, when the prices rise too quickly, they sometimes stay flat or even fall a bit. The idea is that you let the price and value come closer. Once they meet or come sufficiently close, the price starts going up again. If the price keeps going up and up with no real change in value, the difference in price and value eventually gets so large that we call it a bubble. Eventually, the price will correct and fall back to the value, or even below the value. People will realize they were being foolish and life will continue. This is called mean reversion. Predicting the future. We don't have a crystal ball, but we can learn from the past. As per Moody's Analytics, housing prices are overvalued by 25% currently. For example, if something is worth $100, it is selling for $125. Eventually, that $25 gap will be diminished. This can be done in 3 ways. Number 1, the selling price will stay at $125 for the next few years, till the $100 value catches up through inflation. This could mean that prices will stay stable for 2 to 4 years. Number 2, the selling price of houses falls to justify their fair value. Or number 3, a mix of both. Prices fall a little and stay stable for the next few years while inflation catches up. Historically, number 3 is the most likely scenario, but again, we don't have a crystal ball. Currently, housing prices are falling. They've gone down 2 to 5% across America. This number is not concerning as such a slowdown is common in the capital markets. The housing prices ran a lot in the last 2 years and they're taking a breather, catching their breath for the next sprint, which could be any time, tomorrow or 5 years from now. This situation is not similar to the 2008 subprime mortgage crash. We will get to the exact reason for that later in this video. Is real estate a bubble? Is it ever popping? Real estate is not likely a bubble. It is definitely priced at a premium right now, way above its real value, but not nearly high enough to call it a bubble. The fact that real estate slowed down and the prices are coming down shows that the market still has some sense. There's no extended bubble, it appears. Minor falls are good for the economy. It allows investors like you to buy in at a low price. If the real estate keeps on going and it keeps getting harder to justify its price against its value, eventually the bubble will pop. I don't think this is happening in the next 3 to 4 years. What's different from the 2008 mortgage crisis? The 2008 market crash was one of the worst times for Americans. Every 1% increase in the unemployment rate means 40,000 people die from poverty and hunger in America. After the '08 crash, the lending laws were made stringent. Banks are kept under careful scrutiny. The loans are monitored and the asset quality is audited regularly. All of this is to avoid the same mistakes that led to the 2008 crisis. So we know the people who took loans are people who can afford to pay them back. The asset quality is much better than last time. The 2008 crisis was made worse because people who could afford to pay back did not pay back because the loan on the house was greater than the selling price of the house. This situation is called a property being underwater. Imagine you buy the house for $100. You took a loan of $80 at the time to buy the house and paid $20 in your own money. Next year, the price of houses fall by 50%. Your house is only worth $50. Would you pay the bank $80 just so you can own a house worth $50? You would rather default on the loan, let the bank foreclose the house, and get it back for cheaper. That's what people did last time. And this could still happen if the prices fall too much. But right now, the price of the house is still much higher than the loan on them, so default is unlikely. The default on the mortgage is currently around 1%, which is lower than the average of 3%. This is due to the moratorium imposed 2 years ago. It should increase back to 3% in the coming years. The US may go into recession in 2023 as per various reports. This will most likely be a minor recession, just to give the economy time to cool off after a run. It's expected that the housing sector will slow down. The prices will only fall around 3 to 5%. In 2008, the prices fell more than 20 in a single year, initiating a total failure of the economy. Supply and demand. The houses are in short demand because, as I just explained, the interest rates are so high that real estate is not a good investment anymore. Not many investors want to invest in a house right now. In fact, as per banking data, 2022 had the lowest number of mortgages in the last 25 years. The demand for real estate has fallen to an unprecedented low. This puts extreme pressure on the sellers to lower their asking price. There is a slowdown in consumer spending after all. But there's also a supply factor to consider. Both demand and supply together form the price. The land is a finite resource. There's only a limited number of houses that can be built. The supply of land is not increasing fast enough to match the increase in population and Gen Z entering the workforce. This puts upward pressure on the price of real estate. But surprisingly, as per Zillow, not many people are willing to sell their homes either. People are holding their houses and waiting for a better time to sell, hoping that the prices will recover in the future. So, put simply, supply constant but demand decreases. The price will come down along with the number of houses sold in the year. And this is exactly what economists and reports are predicting for the future. Should I buy it or should I wait? It is your decision. If you can find a great value at a justifiable price, go for it. Chances are that the price will not increase in the future, so do your due diligence. But remember to use a mortgage calculator to ensure that you can afford the property. A 7% interest rate can be high. Various tech startups are set to enter the real estate field over the next 5 years. Keep an eye out for them. They may make your life easier. Budget strictly. People always break their budgets when buying houses. This ruins the entire investment and makes buying a bad decision. Avoid cost overruns. Set a budget and stick to it. Do minor repairs yourself to control costs. Sweat equity goes a long way. What will be your decision for buying real estate going into 2023? Let us know in the comments below. If you have any questions, do not hesitate to ask them and I will get back to you. If you haven't subscribed yet, make sure to subscribe and hit the bell icon. If you found this video helpful, give it a thumbs up and don't forget to share the knowledge with those who might find it useful. I will be back with more videos. Until then, take care and stay tuned.